Hello everyone, welcome to our discussion sessions on official mock exam issued by ACCA for Advanced Taxation exam for June 2026 exam attempt. I am Owais Mirchawala, top tutor for Advanced Taxation exam with more than 15 years of teaching experience and a proud tutor of more than 70 nationwide place winner students in this examination of Advanced Taxation. In our today's class, we will be starting discussion on this official mock exam for June 26 exam attempt, and we will be discussing this complete question number 1 in our today's class. Before going in detail of this question, let me brief you about my approach which we will be following during our discussion. First of all, we'll read the entire question, including the introduction and all the exhibits. Then we will be discussing the points which we have to include in our answer. And then at last, we'll completely draft the entire answer during our class discussion in this word processor document. We'll learn that how you have to use these response options. Along with this, during our discussion, we will be using my life-saving summary notes in which I've summarized the entire course of advanced taxation in just 57 pages. All the rules are summarized in these notes. It's the life-saving document in these last few days of your examination. You can circulate around your entire course. Like for example, if you want to refer gift holdover relief, you just go on the search, you write gift holdover, you arrive at the relevant rules. You want to search about business asset disposal relief, you just write business asset disposal relief and you just arrive at the relevant rule. So these summary notes are a life-saving document in this finalization phase of exam preparation. If any one of you don't have these, you can contact me on my WhatsApp number and you can always ask me for this. Okay. See, these complete exam paper discussions are really important before going for your actual examination because it gives you an idea that how you have to deal with all of the topics together in your actual examination, which is obviously the key thing. Normally, what students do is that they have studied the topics, they practice the past papers, but that is topical past paper practice only. See, topical past papers are very easy because at that time the topic is fresh in your mind. But when you talk about complete exam paper, that's a real situation. When all of the topics come together and at that time the things start to get mixed up, time pressure and everything. So practice these complete exam papers. I have discussed 7 complete attempt exam papers in my past paper revision session series, including this mock exam, obviously. Once done with this revision session series, then you have to attempt 3 mock exams on your own and send me for checking and feedback. This detailed course package always helps my students to secure so many nationwide positions. As I said at the start, I'm a proud tutor of more than 70 nationwide place winner students, which is obviously a very difficult thing. Very less tutors like me may have so many positions. And this is because I give a great time and input to my students. So let's start with this mock exam and we'll be starting with question number 1. We'll be reading the introduction screen and we'll see that what the examiner is asking in it. Okay. So let's read. You should assume that today's date is 1st December 2026. You are an ACCA student working for a firm of accountants. Your firm has had a meeting with Aruna and Camellia, potential new clients who are partners in the ACCA partnership. Your manager also requires your help with a long-standing client, Nova Limited, which is part of the Orbit Limited group. See, when you are reading the question and this introduction, normally it's just an introduction that, okay, what the examiner will be asking during this question. So just read with patience and try and identify maximum possible things. Don't rush, don't skip the information. Advice is required in respect of the capital allowances available to the ACCA partnership in the final trading period. Inheritance tax payable by Aruna in respect of transfer of shares into a discretionary trust. So basically he's giving us an idea that, okay, what this question is about. There may be a requirement on capital allowance, a requirement on IHT, then the impact of incorporation relief on the capital gain tax payable on disposal of the business and subsequent gift of shares by Camilla, and the correction of errors in the corporate tax computation of Nova Limited including various items of expenditure, research and development, and use of group losses. So apparently the question is on capital allowances, IHT, incorporation relief, and then some corporate tax adjustments. There are also some ethical issues to be considered if the firm is to accept Aruna and Camilla as new clients. You all know that in advanced taxation, in question number 1, there are always cash marks in relation to ethics. And especially easy for those students who have taken my classes and have studied this handout of mine of ethics, in which I have summarized all the routine requirements which the examiner asks and the important concepts to remember. You all know that this all is due to my approach and my technique of teaching, due to which my students secure nationwide positions in every attempt. Okay, it's always the smart teaching which I have been doing since last 15 years, because I know that, okay, how the examiner asks the things. Now, the following exhibits, which are available on the left hand side of the screen, provide information relevant to the question and outline what you need to do. ACCA partnership, Aruna and Camilla. We'll read each of the exhibit. Nova Limited's draft corporate tax computations, and manager email outlining what you are required to do. The information should be used to answer the question requirements within your chosen response option, which are word processor and spreadsheet. We will learn that how you have to use these response options. Let's look at first exhibit and further deep dive into the question. See, it's very important that you practice these complete exam papers. You see them, that how exactly a complete paper is done, because then only you will be able to understand that how the examiner will be asking you the questions. Are you getting my point? What happened normally is that the students don't prepare themselves for complete exam papers. They don't know how to deal with that situation when all the requirements come together. Now, points to be discussed in the meeting between your manager, Aruna, Camilla, on 1st December 26. Aruna and Camilla began trading as the ACCA partnership on 1st May 2021. Accounts have always been prepaid to 31st March each year using the accrual basis. The partners are each entitled 50% of the revenue profits and capital profits of the business. So Aruna and Camilla started partnership in May 21, 50-50 share using accrual basis for accounting. Let's see, let's look at the data, and then we'll be able to identify that what examiner wants from us. On 1st February 2027, the whole of the ACCA partnership business will be sold as going concern to Glow PLC, a quoted trading company. The consideration for the sale will be mixture of cash and shares. Capital gain tax relief on the transfer of business to a company, incorporation relief, will be available in respect of the sale. So basically an ongoing business will be sold to a company. So it's a situation of incorporation relief. There will be consideration in form of shares also. So whenever there is consideration in form of shares, so yes, we know that incorporation relief becomes available. Now, Aruna and Camilla will both pay income tax at an additional rate in the tax year 26-27 and anticipate continuing to do so in the future year. They are very wealthy individuals who use their capital gain tax annual exemption amounts every year. Both of them are long-term residents in the UK. Okay, so additional rate taxpayer, CGT annual exemptions are used, and they are UK residents. Then, the sale of business on 1st February 2027. Now, focus on the thing, because now we are moving towards our current year. The assets of the ACCA partnership have been valued as set out below. All of the equipments qualify for the capital allowance. Okay. Goodwill value is 1.9 million. The cost of the goodwill was 0. Inventory and receivable 20,000 cost and 20,000 value. Equipment, no item to be sold for more than cost. See here, remember some things. If the equipments are qualifying for capital allowance and they will not be sold for more than cost, so this means there will be no capital gain on the equipments. And on capital allowance eligible assets, capital gain tax only arises when they are in a gain. If there is a loss, we don't get a loss relief on capital allowance eligible assets. The reason is that on capital allowance eligible assets, already the cost is relieved in the capital allowance pool. See, if an asset is eligible for capital allowance, if there will be a gain, it will be chargeable. But if there will be a loss, there will be no loss relief because you already get capital allowances. So no item will be sold for more than cost. So this means that equipments are also exempt for CGT. Inventory and receivable is also exempt for CGT because it's a current asset. Capital gain tax will only arise on the goodwill. Now, the total value of the consideration will be equal to the value of the asset sold. Aruna and Camilla will each receive consideration of £1,010,000. £110,000 in cash and 200,000 shares in Globe PLC. So this means that 110,000 is each person's cash consideration. So if I remove 110,000 from 1,010,000, so this means that 900,000 pounds worth shares will be given. 900,000 pounds worth shares will be given. Okay. Now, future transactions, disposal of shares. Aruna's transfer of shares to trust. See, we are just reading the scenario. I'm not thinking about that, okay, what I'll have to do. I'm just reading the scenario. I'm trying to identify the things. When I'll go and read the requirement after the exhibit, then I will think in detail. Believe me, it's very easy. Just approach with care. Don't rush. On 1st July 27, Aruna will make a gift of 15,000 of her shares in Globe PLC to the trustees of Discretionary Trust for the benefit of her nieces and nephew. So when we make a gift to trust, it is considered as chargeable lifetime transfer. When we make a gift to a trust, it's a chargeable lifetime transfer. Aruna will pay any inheritance tax liability in respect of this gift. The trustees will transfer the shares to the beneficiaries over the life of the trust. Aruna has already made the following gifts. On 1st June 25, cash gift of £280,000 to a discretionary trust. 1st August 26, cash gift of £70,000 to one of her nephews. See, you must be thinking that, sir, 12 minutes have passed. We haven't solved anything. We haven't discussed any such thing. See, same happens in the examination. I know the answer. I can just start writing the answer. But I'm solving it just like you will do in the examination. Just read it, we analyze it, and then we'll start drafting. We'll just reading, gathering up the data that, okay, there was some detail in relation to the sale of the business. Business was sold to Globe PLC. We looked at that. Now, gift of asset to trust. Let's look forward. Camilla, gift of shares. On 1st May 28, Camilla will gift 40,000 of her shares in Globe PLC to her son. For the purpose of giving our advice, the value of shares in Globe PLC can assume to be £4.5 on 1st February 27, £5 on 1st July 27, and £6 on 1st May 28. So this is all. Our first exhibit, Aruna and Camilla, is done. Now we all know that exhibit number 2, Nova Limited, is a completely separate debate. It has nothing to do with ACCA partnership. Because as you read the introduction, it was clear that our manager has asked to work about this ACCA partnership thing, capital gain, capital allowance, then IHT, then Incorporation, and then a complete different discussion in relation to Nova Limited. Here also he stated, your manager also requires your help with a long-standing client, Nova Limited. That's a completely separate thing. See, normally the students ask that, sir, whether we should read the requirement first or the exhibit first. It's always better to read the exhibit first. Now in the exhibits also, sir, shall we read all the exhibits or we go exhibit by exhibit, like exhibit and then requirement? Normally you read the entire question. But sometimes questions like this, when it's clearly identifiable that this is a completely separate story, and then exhibit 2 has a completely different story, like another company detail. So now you can do that. For time being, you can skip this exhibit and you can look at the manager's email. See, in question number 1, we all know If you haven't done the past paper revision sessions earlier, let me tell you for the first time. But if you have watched my other sessions, you already know that in question number 1, requirement is just like this one, brief. Respond to manager email. All the requirements in detail are given in the manager's email itself. So we have to look at the manager's email carefully. Requirement tab itself is useless. It says respond to the manager email 40 marks and 10 marks for professional skill, for communication, analysis and evaluation, skepticism and commercial acumen. That when we will be solving the answer, I will be guiding about these things in detail. So the key document is the manager email. Okay, let's look at it and we'll be looking at the things along with this. There are a number of separate tasks that I would like you to perform as detailed below. Part A. Becoming tax advisors to Aruna and Camilla. It is anticipated that Aruna and Camilla will require some highly sophisticated and specialized tax planning work in the future. Set out information that would be required and actions that should be taken by the firm before it agrees to become the tax advisor to Aruna and Camilla. So it's a very simple question, matters to consider before becoming tax advisor to someone. It's an ethics question. Just go to my handout, routine ethical situations. Here you go. This document is not made after this past paper. I've already taught you in the classes. Just look at my things, how I have presented and taught you the course. Factors to consider before accepting tax engagement. If it's a new client, you look at the proof of identity and the address. If it's a company, you look at the registered head office things. Here we are talking about Aruna and Camilla. They are individuals. So we look at their proof of identity and all. We talk about their existing client, existing accountant. We take a professional clearance. If new client is being considered and they already have an accountant or a consultant, then you must contact the existing accountant, whether or there are any matters which you should be aware of. Okay. Obviously, the previous accountant will not reply you directly. He requires permission from the client. So whether the client gives him the permission or not. You think about availability of resources and competence. The reason being is that they clearly said that they require some highly sophisticated and specialized planning. You think about any issue of conflict of interest. Why conflict of interest? Because Aruna and Camilla were the partners in the same firm. So maybe when we advise one, it hits the interest of another party. Because we have to think about the benefit of our client. Now, both of the partners are our client. So maybe if any conflict of interest situation exists. So issues to consider while becoming a tax advisor to Aruna and Camilla. Let's look at it. We will start with the word processor document. I want you all to understand and see what I'm doing. The question name, Aruna and Camilla. Okay. Now, see, in this part, he didn't ask you to make an email or a memorandum or something. In part B, he asked you to prepare a memorandum. Listen to the examiner's requirements carefully. That is also part of communication skill. See, you all know that in question number 1, there are 40 technical marks and 10 marks are for professional skill. In professional skill, what is communication? Listening to the examiner instructions and then responding properly. Two-way communication. He asked you to prepare a memorandum for part B. Okay, so we'll make it there. Clear wording, headings, that is communication. Analysis, analyzing the tax rules, making calculations, evaluation, relating to the scenario, evaluate it. Skepticism, questioning the things, challenging the things. Like for example, in one of the requirement of this question, we have to review the computation done in the question. We have to check the computation done in the question. So that is skepticism. We question the things. Commercial acumen, when we give any practical advice that, okay, this thing is better or this thing is better. All of these skills, we look at it when we'll be solving the answer actually. Now the part A is becoming tax advisors to Aruna and Camilla. I will copy this requirement from here. Sometimes in the examination, copy paste function don't work. So no issue. You have to type it then. If it works, it's Easy. If it do not work, don't panic. Don't panic in the examination. Fair enough. If it's not working, you will type everything. It was working, so I copied and pasted you. Becoming tax advisor to Aruna and Kamala. What he's asking? Set out the information that would be required and the actions that should be taken by the firm before it agrees to become the tax advisor for Aruna and Kamala. Okay, so our firm should take information about proofs of identity of Aruna and Kamala before agreeing to become tax advisors to them. Proof of identity may include, what proof of identity may include? It may include details about their addresses, details about their nationality, okay, their passport or something, their identity documents, okay. Proof of identity may include details about their nationality and legal documents. This will also include details about their residential addresses, so that we know that, okay, the person to whom we are providing service, who he is UK national, or he is some Uganda national, or some African national, whatever he is. We need to know about the client. That's the most important thing. So before agreeing to provide service, we need to know about their identity. See, this all I have already taught. Additionally, details about previous service provider also need to be taken, and our firm should contact the previous tax advisor of Aruna and Kamala in order to gain detail that if any ethical issue exists, this will be important to know before agreeing to become tax advisor of them. See, we will contact that previous advisor. Okay, who was your previous advisor? We need to contact that previous advisor. In terms of ethics, we call it as professional clearance. Okay, our firm also need to consider that whether we have sufficient resources and competence to provide services to Aruna and Kamala, as they are looking for, as the question said, they are looking for highly sophisticated and specialized tax planning, as they are looking for highly sophisticated and specialized tax planning services. Okay, expertise and competence to provide relevant services is important to consider. Like, we need to talk that, okay, what you are looking for. Maybe they say we need advice for inheritance tax, and our firm don't know how to provide advice for IHT. That's normal. Every firm is not expert for every area of taxation. Okay. Another matter to consider is potential conflict of interest which may arise, as our firm will be advising two partners of same business. It is possible that advice for one partner may conflict the interest of another partner, which is also client of our firm. Like, just take an example. For example, at the time of dissolution, distribution of asset and all is happening. So maybe we say, okay, you take this asset, this is good one. This will help you in saving tax, or we are giving any sort of advice. So maybe that is beneficial for one of the client, but harming the interest of another client. Okay. So what action we can take in order to reduce issue of conflict of interest? Our firm should inform both of the clients initially and also use separate teams for providing service to both of the clients so that one team do not get in a conflict of interest situation. Okay, like, okay, team A or partner A will deal with Aruna and partner B will deal with Camel, so that one particular team do not get in a situation of conflict of interest. Okay, so that one particular team do not get in a conflict of interest situation. So, like, ethics question is easy cash in the examination. Just look at it. Details about their identity, contact the previous advisor, think about the resources, conflict of interest, and this is the action we do. Just look at it. These all things we have discussed. Okay, like use separate teams, inform them. This is what we do whenever there is a situation of conflict of interest. Even the conflict of interest concept I have taught you guys in the class. If you remember, the conflict of interest. Whenever conflict of interest happen, what we have to do, what's the concept of conflict of interest and all we have discussed in the class. So if you just look at it, I say to my students always, when you are in the examination, relax. Don't rush. Don't run fast. Read the question. You already know the best. Just answer it. What we have to consider before becoming advisor? Proof of identity, previous accountant or advisor, resources, conflict, and what action we can take. It's done, 5 months. Done. Now let's move forward. Part B, the ACCA partnership. Okay, let's see what he's asking. The ACCA partnership, this is the part B. Okay, now here the examiner is saying, I want you to prepare a memorandum for the client files. Okay, fair enough. It's a standard format. The examiner either asks for a memorandum or notes for the meeting. These are the only two formats asked in advanced taxation. And they have the same format, just change the heading. Memorandum for client files. Okay, to the client files, because we are not addressing it to someone, we are just making the memorandum for the client file. From, you are a tax supervisor in the question always. Why? Because you are being addressed by the manager. It's a manager's email. So you are always a tax supervisor. Okay. Client is ACCA partnership. Okay. What is the date? Please don't write the date of the examination. The date is the one which is given in the question. Now, if you go and look at the exhibits, you can find the date. Points should be discussed in a meeting between your manager Aruna and Kamala on 1st December 26. So this is the date. 1st December 2026. What is the subject? ACCA partnership. ACCA partnership sale and personal tax affairs of Aruna and Kamala. Okay. This is what is being covered in part B. The ACCA partnership, capital allowances, Aruna transfer of shares, Kamala impact of incorporation relief, that all is part of part B. Then part C is a separate thing. That's Nova Limited review of corporate tax computations. So currently we are dealing with part B, which is the ACCA partnership. I want you to prepare a memorandum for the client files in respect of the following. So memorandum for the client files. To the client files from the tax supervisor, client, date, subject. And now you directly start the answer. Now you will directly start the answer. Just pick up the first requirement, capital allowances of ACCA partnership for its final trading period. You copy, you paste it here. And now you will start dealing with this. See, part A was ethics, very easy, 5 marks. Part B, the ACCA partnership, memorandum for the client files, the examiner asked for it. To, from, client, date, subject. If you something up down happened, like date comes first, client comes later, no issue. Okay. If it would be notes for the meeting, just change the heading. otherwise remains the same. And now, the first requirement, capital allowance of the ACCA partnership for its final trading period. Let's look at it. Okay, so let's look at it. A detailed explanation of the calculation of capital allowances of the ACCA partnership for its final trading period ending with the sale of its equipment to Glow PLC for £100,000 on 1st February 2027. It's a 4 marks requirement in which we have to explain that what will be the capital allowance adjustment in the final trading period. Because after that, the business will be sold to Glow PLC. So whenever the business is ending, okay, what we do in the capital allowance pool, we have the opening balance. If there are any additions done during the year, we add them. If there are any other disposals during the year, we adjust them at lower of cost or disposal proceed. Always remember that in the final trading period, there is no annual investment allowance, there is no first year allowance, there is no written down allowance. Why? Because in the final trading period, the pools will be closed. Whatever the ending balance is, that is converted into balancing allowance or balancing charge. In the year of cessation, the year in which we cease the business, in which we end the business, we don't claim normal allowance. Like you will not claim written down allowance because there is no point of carry forwarding the balance to the next year and all. So whatever balance is in the pool, you simply close it through balancing allowance or balancing charge. Okay. Now, since the business is not sold to a connected company, Glow PLC is not a connected company. It is not in our control. You can check it. Glow PLC, each Aruna and Camilla owns 3.1% shareholding each. So it's like 6.2% in total. So they don't have a control. So Glow PLC is not a connected company. So the assets cannot be transferred at tax written down value. The pool needs to be closed out. Okay. So in final trading period of ACCA partnership, normal capital allowances will not be claimed, which are in form of written down allowance, annual investment allowance, and first year allowance. Rather, capital allowance pools will be closed through balancing adjustments, which may be balancing charge or balancing allowance. Okay, it will be calculated in following manner. See, in the final year of the trade, when it's the final year of the trade, you don't claim normal capital allowances like written down allowance, which you claim every year, or annual investment allowance, or first year allowance, or something like that. Rather, you have to close the pools through balancing adjustment. Okay. Now, how the balancing adjustments are calculated? Obviously, you all know this. Tax written down value at start of final period, whatever your last trading period is, the tax written down value at the start of the period, addition of new assets, if any, new assets purchased during the final period. So you add them in the capital allowance pool. Okay. Disposals made during the final period, okay, will be adjusted or will be removed. They will be removed from pool. They will be removed from pool at lower of cost or disposal proceed. See, we don't know the exact value, so we are just writing this cross. Okay, so balance in the pool, whatever balance in the pool remains, and then as the question stated, with the sale of the equipment to Glow PLC, the final closing of the business for £100,000. Okay, so final disposal of equipment on cessation of business, or I would say on sale of business. Okay, it will be removed from pool at lower of cost or disposal proceed. of 100,000 pounds. I will copy the pound sign from here. I will repeat the things again also, so don't worry, just listen carefully so that you can understand in a better manner of 100,000 pounds. So as the question stated that no asset was sold for more than cost. So this means that disposal proceed will be lower off. Okay. So the remaining will be called as a balancing allowance or a balancing charge. Okay. If balance remaining is positive, it will be a balancing allowance. And if it is negative, it will be a balancing charge. Okay. Equipment was sold for less than its cost. Therefore, lower of value will be disposal proceed. I will repeat the things again also, so don't worry, just listen to me carefully. We'll look at the things again also. See, in the final trading period, what you need to understand is, in the final trading period, you don't claim normal capital allowance. Rather, you close the pools through balancing adjustment, which may be a balancing allowance or it may be a balancing charge. Okay. Now, whatever tax written down value at the start of the period is, if you have made any purchases during the final period, you add them, but you don't claim any AI or something. Because now, whatever the balance in the pool is, you have to close it. If any other disposal is made during the year, so you adjust that. And then the final disposal is done on 1st February 2027. So final disposal of equipment on sale of business, which is 1st February 2027. It will be removed from the pool at lower of cost or disposal proceed. So the disposal proceed is 100,000 because the scenario stated that none of the equipment will be sold will be for more than its cost. But this is happening on 1st February 27. Obviously during the year also maybe there are other disposals, so that you will remove from the pool at lower of cost or DP. So now balancing allowance or balancing charge. Balancing allowance is an allowed expense from trading P&L, whereas balancing charge becomes a taxable amount. Okay, it increases our income, or you can make it more simple. Rather than becomes a taxable amount, you can say whereas balancing charge increases the trading income. Okay, just for your ease. Okay, assets of ACCA partnership will not be transferred to Glow PLC at tax written down value, as Glow PLC is not a connected company of owners of ACCA partnership, as they do not have control in Glow PLC. Okay, they own less than 50% shares. So it was a very easy 4 marks requirement, I would say. That in final trading period, normal capital allowances are not claimed, rather the balancing adjustments are. If you don't remember the rules, you can just go to the summary notes, you can write capital allowances, you arrive at the rules of the capital allowances, and you have studied them during your course discussion also. Okay, so you have studied all the rules of the capital allowance, that how you do the adjustments, like here in the year in which the business is seized. Here obviously the business is not seized, but ACCA partnership is getting seized, because then ACCA partnership will end and assets will go to Glow PLC. So from ACCA partnership perspective, the business is seized. So normal capital allowance is not claimed, rather entire value in the pools are shifted to allowance column after doing the balancing adjustments, or what we call as the disposal adjustments. You may get a balancing allowance or a balancing charge. Okay, if the business would have been sold to a connected party, then in that case they would have been transferred at tax written down value. But here it's not a connected company, because the reason is that in Globe PLC we don't have the controlling shares. So I believe it's an easy one. Like capital allowance of AK partnership for final period, it was like an easy requirement. Normal allowances are not available. You just get a balancing allowance or a balancing charge. Okay, now let's move forward. Let's see further what he's asking. Now in part 2 is asking Aruna transfer of shares to trust. Okay, now let's look at this requirement. It's apparently an inheritance tax requirement. Now, let's look at it. So let's see what he's asking here. A calculation of the inheritance tax payable by Aruna in her lifetime in respect of the gift of shares to the trustees of discretionary trust. Don't get confused that, sir, it is giving assets to trustees. So is it a gift to individual? No, it's a gift to trust. Because if you remember in the course discussion, we have studied that in discretionary trust, trustees are the powerful party. So when it's written to the trustees, it's in fact being given to the trust. It's not given to any individual. So don't get confused. On 1st July 2027 and the date on which the tax would be payable, you should note that the gift would not qualify for business property relief. Okay, so it's a 6 marks requirement. We have to calculate the lifetime tax payable by Aruna in her lifetime in respect of the gift of shares to the trust. Okay, so let's go and look at it. If you remember, Aruna is making a gift of 15,000 shares in Glow PLC to the trust, and it's on 1st of July 2027. We just have to calculate lifetime tax, then it's Camilla. So for Aruna, it's this part only. So I believe that you just need to listen to me carefully and it will be an easy one. You just have to make the calculation of the lifetime tax, a calculation of the inheritance tax payable. Okay, so it's a lifetime gift of shares by Aruna on what's the date? The date is 1st July 2027. On 1st July 2027, which will be tax year of 2027-28, to a trust. Okay, IHT, or I would say lifetime tax payable on it will be. So let's do the calculation of lifetime tax. Now, if you want, you can do these calculations on spreadsheet also. Completely up to you. Okay. But like if you do on the spreadsheet, you will just write a reference in the word processor document that workings done in the spreadsheet. I normally like to solve my entire answer on the word processor document. So I add a table and I solve it here only. But it's completely up to you. There is no pressure. There is no stress. Don't get yourself occupied or in some sort of stress that, oh, sir did in Word, so I also have to do it in Word. It's completely your choice. Okay. Now, what's the value of transfer? How many shares are being gifted? 15,000 shares are being gifted. Now, if you go down, the valuation of shares is given. On 1st July 2027, each share worth £5. Okay. I'll copy the pound sign. Now, each share worth how many pounds? £5 on 1st July 2027. So, value of transfer is 15,000 shares into £5. So, that gives us 75,000 pounds as value of transfer. Then comes annual exemption. Current year is 2027-28 because gift is made in July 27, and then there will be annual exemption of previous year, which will be 2026-27. So let's see that what other gifts she has made. She has made a gift in August 26. So the annual exemption of 26-27 is already used. It was used against cash gift to one of her nephews. But in 27-28, there is no gift made. Okay, so current year annual exemption is available. Current year annual exemption is available, but last year annual exemption is not available, already used against gift made in August 2026. Yes, so it's already used against that. So that gives us the value of chargeable lifetime transfer. 75 minus 3, it's 72,000 pounds. Done. I believe it's like very basic IHT work. You all know this. It's not a difficult thing. It's very basic IHT calculation which I am doing. Now comes the nil rate band, because you have to calculate the lifetime tax. Lifetime tax. So you will pick up the nil rate band of 2027-28. So nil rate band is always 325,000 pounds. Last 7 years chargeable transfers. See, when you are talking about lifetime taxes, always remember that last 7 years chargeable transfer will only be a CLT, because in lifetime taxes PAT are not chargeable. This is a PAT. PAT is not a chargeable. Gift to a nephew is a potentially exempt transfer. It's not a chargeable transfer. For lifetime taxes, only CLTs are chargeable. And this was a CLT which was made in June 2025. It was a cash gift of 280,000 pounds to a discretionary trust. Okay. So if I write a note 1, because it will be a bit detailed one. Note 1. For lifetime taxes, only chargeable lifetime transfers are chargeable, which include gifts to trust. Gift to individuals are not chargeable for lifetime tax. They may become chargeable for death tax, but not for lifetime tax. In last 7 years, chargeable transfers, Aruna will have a gift to trust made on what date? Made on 1st June 25 of 280,000 pounds. Made on 1st June 2025 of 280,000 pounds. Its CLT value will be 280,000 pounds minus 3,000 and minus 3,000, annual exemption of 2 years, because there was no chargeable transfer before this. So that gives us 274,000. Annual exemption of both years was available for this CLT, as there was no transfer before it. Okay, so your last 7-year chargeable transfer will be 274,000. Believe me, it is just like a normal practice question which I am doing. See, PAT is not chargeable for lifetime taxes. It's a gift to nephew. In last 7 years, there is this gift to trust of 280,000. There is no gift before this one. So obviously the annual exemption of both years will be available. So CLT value is 274. This gives us available nil rate band. So 325 minus 274, it's 51,000 pounds. Okay. So what will be the lifetime tax? On 51,000 pounds, you will charge 0% tax, that gives you 0, and remaining 72,000 pounds minus 51,000 pounds. So that gives us 21,000. Now, who is paying lifetime tax? Let's go and check it. It's written in the question. Aruna will pay any IHT liability in respect of this gift. So this means donor is paying tax. Okay. So 25% tax. 5250. Aruna, who is the donor, will pay lifetime tax. Therefore, tax rate will be 25%. Gross CLT will be how much? 72,000 pounds plus 5250. Okay. 72,000 pounds plus 5250, it will be 77250. Okay. So total lifetime tax 5250. Now another question was that when it will be paid, what is the due date of this tax? On which date this tax will be payable? So if you all remember, for lifetime taxes, the rule for tax payment is that if gift is made in first 6 months, listen to me carefully. If the gift is made in first 6 months of the tax year, then IHT is payable by 30th of April of next year. Whereas if it is made in last 6 months of the tax year, you have to pay tax in 6 months after the month of gift. These all things you have studied, okay? You have already studied these inheritance tax, tax payments and all, okay? If you don't remember tax payments, if you just go to tax payment dates and you go and explore the IHT tax payments, okay, I must have taught it in inheritance taxes, and you go down in inheritance taxes, I have taught IHT administration. Yes, if the gift is made in first 6 months of the tax year, okay, then you have to pay the tax by 30th of April. Whereas if the gift is made in the last 6 months of the tax year, you have 6 months time to pay the tax. Okay, so if you go and look at it here, this gift was made on 1st July 27. Obviously, 1st July 27 is in first 6 months of the tax year. Okay, lifetime tax of 5250 will be payable by 30th April 2028. As this gift was made in first 6 months of the tax year, therefore IHT is payable by 30th April of coming year. Okay, coming year or the next year. I will repeat the things again also, so if you will have any query, it will get clear. But obviously, the important thing is to listen to me carefully first. It's an easy one. Okay, see, we have to calculate lifetime tax on gift of shares to trust. So lifetime gift of shares by Aruna on 1st July 2027 to a trust, lifetime tax payable on it will be, we simply picked up the value of transfer. These were 15,000 shares valued at £5 each, so it was £75,000. Annual exemption current year and last year it was not available. You got the value of CLT. Then comes in the nil rate band. You looked at the nil rate band. It was used by last 7-year chargeable transfer by 274,000. The PAT do not uses NRB. Only CLT will use nil rate band. And in last 7 year, there was only one gift to trust, that was of June 25, £280,000. You got available nil rate band, 51,000 at 0% and remaining at 25% because donor was paying the tax. You calculated gross CLT value also. Now lifetime tax will be payable by 30th of April of the coming year because the gift was made in July 27. The lifetime tax will be payable by 30th of April. Why 30th of April? Because gift was made in first 6 months of the tax year. You all know tax year starts in April, and first 6 months, April, May, June, July, August, September. This gift was made in the month of July. So when it's made in the first 6 months of the tax year, you have to pay tax by 30th of April of the coming year or whatever nearest 30th April is. Okay, will be payable by 30th of April of coming year or the nearest year, or you can just write 30th of April, that's also sufficient. Okay, so if you look at it, if you look at the things carefully, how much we have done, we started with an ethics requirement that was a 5 marks. We did this 4 marks capital allowance requirement. We did this 6 marks requirement of gift to trust. Now comes a big one, a 14 marks requirement. As the marks tell, it must be a good requirement. So let's look at part 3, that's Camilla's impact of incorporation relief. Let's see what he's asking here. Okay, just a second. Let me paste the requirement and then we'll deep dive into this one also. Now, let's read this, that what he's asking. Okay, 14 marks is a good requirement, so you need to concentrate on the thing. A review of whether or not Camilla should disclaim incorporation relief. Okay, the review should encompass, which means include, the sale of AK partnership business, gift of shares to Camilla's son, and the effect of incorporation relief on the base cost of the remaining shares owned by Camilla, as she intends to sell all of her shares in Glow PLC in the next few years. See, if you look at the scenario, if I like remind my mind, what was the scenario? Camilla and Aruna were doing their business as AK partnership. They sold the business to Glow PLC. So they are selling their ongoing business to a company, and from the company they were getting share consideration. There was cash consideration also, but there was majorly share consideration. So they can get incorporation relief on the share consideration portion. So now what the question is that whether Camilla should claim incorporation relief or disclaim it. Okay. If you remember in the classes also we had done such situation. You should include a summary of your calculation and the statement of the key issues for me to discuss with Camilla. You should also include brief explanation on the amount of incorporation relief available, the availability of any additional or alternative reliefs, and the dates on which any capital gain tax will be payable. 14 marks. So we have to make a review for the business that whether Camilla should disclaim incorporation relief or not. Okay, so let's start with this question. I want you all to listen to me carefully. It's a 14 marks requirement. So at the very start, I'm saying that, okay, you have to be very alert and you have to try and understand things. But if you approach the question in the right manner, it will be an easy one. Now, if we start developing the answer for this requirement, see, we have to develop a comparison that whether incorporation relief should be applied or it should be disapplied. So for that, we will make a comparison table because obviously this comparison will involve a situation when incorporation relief is applied and when incorporation relief is disapplied. Okay, listen to the things carefully and you will be able to understand the things in a much better manner. If incorporation relief is applied, we will make one working in this head, and another is if incorporation relief is disclaimed. Okay, so let's look at it. See, if you look at the requirement also, it was presented in a very good manner. A review of whether or not Camilla should disclaim incorporation relief. Okay, now what this review has to include? Sale of AK partnership business, start with that. Then gift of shares to Camilla's son, and then the effect of incorporation relief on the base cost of remaining shares. Okay, so basically if you look at the scenario, AK partnership business getting transferred to Glow PLC first of all. So the first head we'll create is sale of AK partnership business to Glow PLC. Okay, at every step we are looking at two things. If incorporation relief is applied and if incorporation relief is disapplied or disclaimed, then what will happen? Because we have to talk about the impact of incorporation relief on the chargeable gains, on the tax, and on the base cost of the shares. Now, this sale of business is happening on 1st of February 2027. Okay, so I will add this date also, 1st February 2027. Now, since it's a 14 marks requirement, so you have to write like explanatory notes and all, and you have to go step by step. Now, on this sale of business, if you look at it, what are the assets involved? There is a goodwill, which has a value of 1.9 million. Its cost is 0. There is inventory and receivables. Its value is 20,000, cost was 20,000. And then there is equipment. See, now what you need to remember is that inventory and receivable are exempt assets from capital gain tax. Similarly, equipment, when it is not sold for more than cost, for capital gain tax purpose, it will be an exempt asset. Because assets which are eligible for capital allowance, like equipments, if they are in gain, then CGT applies. But if they are in loss, capital gain tax do not apply because you are already given with the capital allowance. Okay, so for sale of business, I will add one note 1 to explain this thing. Note 1. On sale of AK partnership business to Glow PLC, only goodwill asset will be chargeable for capital gain tax, as other two assets are exempt from CGT. Inventory and receivables are are current assets and they are exempt from CGT. They are categorically in the exempt list of the CGT. Further, equipment will be sold at less than its cost. Therefore, it will also be exempted from CGT as it is capital allowance, eligible asset, and its gain can be chargeable only. Okay, it will be sold at less than cost. So when it is being sold at less than cost, use your mind, it will be in a loss. And on capital allowance eligible assets, loss relief is not given because you already get capital allowance on them. Yes, if there would be a gain, the gain would have been chargeable. Okay. Now capital gain on goodwill element is how much? Is 1.9 million complete because its cost is 0. Its value is 1.9 million. Listen to the things carefully because it's a 14 marks requirement. There will be small steps where you can make a mistake. Capital gain on goodwill element is 1.9 million as its value is 1.9 million, whereas its cost is 0. Okay. Camilla owns 50% of ACCA partnership. Therefore, chargeable gain on her portion will be 1.9 million into 50%. So that will be 950,000. Chargeable gain. See, this chargeable gain will come in both of the columns. Okay, because now incorporation relief will be the next step. Sir, will you repeat the things again? Yes, I will repeat the things again. I will go slow by slow. Some students may feel that sir is going slow, we need to speed up, but I'll go step by step. I'll repeat the things so that it goes in a well-structured manner because it's a 14 marks requirement. I don't want to miss anything in between because I know that if we go in rush and some of the students will get confused, then it will become a problem because later on I'll have to repeat it again. Okay. So one column we have created if incorporation relief is applied, another is if incorporation relief is disclaimed. So on sale of ACCA partnership business to Glow PLC, the chargeable gain for Camilla's share is 950,000. Okay. On sale of ACCA partnership business to Glow PLC, only goodwill asset will be chargeable for capital gain tax, as other two assets are exempt. Inventory and receivables are current assets and they are exempt from CGT. Equipment will be sold at less than its cost. Therefore, it will also be exempted from CGT as it is a capital allowance eligible asset and its gain can be chargeable. Capital gain on goodwill is 1.9 million. Camilla owns 50% of ACCA partnership. It was written here. They each own 50% of the share of the business. So the Camilla's share will be 950,000 in the goodwill. So I can say capital gain or a chargeable gain on goodwill will be 950,000 for Camilla's portion. Now comes incorporation relief. I want you all to listen to me carefully. See, if incorporation relief is disclaimed, then in this portion it will be 0. But if incorporation relief is applied, then in this portion incorporation relief will come. Note 2. Incorporation relief will be on share consideration portion only. Camilla received total consideration of how much? If you go and look at it, Camilla received total consideration of 1,010,000. Each received consideration of 1,010,000. 110,000 in cash and 200,000 shares. Camilla received total consideration of 110,000. Sorry, 1,010,000. 1,010,000. Camilla received total consideration of 1,010,000, out of which cash consideration was 110,000. Share consideration will be 1,110,000 minus 110,000. So share consideration portion will be 900,000. Incorporation relief will be, you all know that when there is share consideration and cash consideration involved both, so incorporation relief is only on share consideration portion. So your gain is 950,000 pounds multiplied by share consideration is 900,000 divided by total consideration, which is 1,010,000. Okay, it's presented in such a way that students may make a mistake. 1,010,000 is the total consideration each is receiving. 110,000 is cash. So automatically the remaining will be share consideration. These 200,000 shares will worth 900,000 pounds in the value. 1,010,000 minus 110,000. So remaining will be 900,000. Okay. So 950,000 pounds multiplied by 900,000, which is the share consideration, divided by total consideration. So the incorporation relief will be 846,355. 535. 535. You have to do it on the calculator. 846,535. So that is the incorporation relief which will apply. So now, what will be the chargeable now? See, just look at it how I am doing the working. Okay, 950,000 multiplied by 900,000 divided by 1,010,000. It was 846,535. So 950,000 minus 846,535. So here the chargeable now portion is 103,465. And here it will be complete 950,000 obviously. It will be complete 950,000 pounds here. And here it's 103,406 pounds. So now this is your chargeable now. You deduct your annual exemption. What will be your annual exemption? You go and look at the scenario that whether the annual exemption is available or not. So if you go and look at the Camilla situation, it's only written that Camilla will give 40,000 shares on 1st May 28 and then rest is the valuation of the shares. Anything else written about them? Okay. They are very wealthy individual who use their capital gain tax annual exemption amount every year. So if the capital gain tax annual exemption is already used, it's written in the scenario. Okay. Already used every year by Camilla. It was written in the scenario. So that gives us the taxable gain. Here it will be 103,465 and here it will be 950,000 pounds. Now comes the capital gain tax. What will be the capital gain tax? Let's look at it that what capital gain tax value will be coming. See, you are selling your ongoing business to a company. So it will qualify for business asset disposal relief because we are selling an ongoing business. When you sell an ongoing business, it is eligible for BADR, for business asset disposal relief. See, you all have studied this interaction of incorporation relief and BADR in your classes. We have done such questions in our classes. You already know that how that works. Okay. So now look at the BADR working. Let's write a note on that. Note 3. Business asset disposal relief will be available on sale of ACCA partnership business as it was a sale of ongoing business and business was done for more than 2 years, was done or was owned for more than 2 years. If you go and look at the scenario, they have been doing this business since when? They've been doing this business since 2021. Okay, so it was done for more than 2 years. Now, one important thing which some students will have in their mind, that it is a gain on sale of goodwill. And we have studied that on goodwill portion, business asset disposal relief is not available. See, that happens when you are selling a goodwill to your own close company, a company in your own control. That is not a situation here because in Globe PLC, they don't have controlling shares. Okay. restriction of business asset disposal relief on goodwill portion gain will not apply as Glow PLC is not a closed company. Okay, it is not in control of this Aruna and Camel because their ownership is like 3.1% each. Okay, and this Glow PLC is a quoted company, so there is no detail that it's a closed company, and even none of them owns at least 5% shares also. Okay, so the capital gain tax will be applied at a rate of 14%, 103,465 into 14%, which is the capital gain tax rate when business asset disposal relief applies. So it's 14,485. 485. And here 950,000 pounds into 14%. Into 14%, so it's 133,000. Sir, will you repeat the things again? Yes, I will repeat. See, it's a 14 marks requirement. The question has just started. So listen to the things carefully. If you have any queries, don't worry. I will repeat the things again. But if you will rush, it will become a problem. See, the question is that what will be the impact of incorporation relief? So we made two columns, if incorporation relief is claimed and if it is disclaimed. Okay. First of all, we started with sale of business to Glow PLC on 1st February 2027. Okay. We started with the sale of business situation. Chargeable gain in both of the heads. Incorporation relief is applied. So it will be applied on the share consideration portion. Okay. We got chargeable now. Annual exemption was already used. We got taxable gain and we did CGT. Business asset disposal relief was available because it was a sale of ongoing business and the ownership was also for more than 2 years. Restriction did not apply. The reason being was that it was not a sale of goodwill to a closed company. Now, the question said one more thing, that whenever you calculate the tax, you also need to tell the dates and the dates on which any capital gain tax will be payable. So we are going step by step. By what date the CGT will be payable? This transaction is happening on 1st February 27. So this is tax year of 26-27. CGT is payable on 31st of January after the end of tax year. Okay. Capital gain tax on sale of business to Glow PLC will be payable on 31st of January 2028. Why? Because see, 1st February 27 is tax year 26-27. It ends on 31st March 27. The tax will be payable on 31st of January after that. So capital gain tax on sale of business to Glow PLC will be payable on 31st of January 2028, which means there's 14,488 and 133,000. Okay. Now let's move forward. Base cost of shares received from Glow PLC. See, now we are moving forward. Okay. Since we have claimed incorporation relief, so there will be base cost of shares working. Received from Glow PLC on 1st February 2027. Market value of shares. What is the market value of shares we have received? So these were 200,000 shares we have received. On 1st February 2027, each share worth 4.5 pounds. Okay. So 200,000 shares into 4.5 pounds. So that is 900,000 pounds. Okay. Incorporation relief reduces the base cost, you all know. So in this case, we claimed incorporation relief of how much? 846,535. 535. And in this case, we did not claim any incorporation relief. See, I am doing side by side working. Why? So that the question goes in a parallel way. Otherwise, there will be a lot of repeat working. Market value of the shares, less the incorporation relief claimed. So this gives you base cost of 200,000 shares on 1st February 2027. 846,535. So my base cost of shares is 53,465 here, and here it's 900,000 complete. Just listen to me carefully. I will repeat each thing again also. So due to incorporation relief, the base cost of shares has reduced here and it has fallen to 53,465. 900,000 minus 846,535. Yes, this is the base cost. And here it remains at 900,000 only. Now look at the requirement. Sale of ACCA partnership business? Yes. Now the gift of shares to Camilla's son. Okay. Gift of shares to Camilla's son. Now on what date this gift is happening? On 1st May 28. How many shares are being gifted? 40,000 shares. Gift of shares to Camilla's son on 1st May 2028. Okay. How many shares? 40,000 shares of Glow PLC. Okay. Now some of you guys must be thinking that, sir, in the examination, how will we be able to do it? Like, we are looking at you, you are doing it in this way. Like, how will we be able to solve it in the examination? Like, our mind won't go in that structured manner. See, that's completely normal. You don't pass your exam at 100 marks. You pass at 50 marks. Be relaxed. Do in the maximum possible manner. Maybe you just do incorporation relief working first and disclaim working separately. That's completely okay. Okay. Now, gift of shares, 40,000 shares, so disposal proceed will be equal to market value of shares on that date. Okay. Now, what is the market value of shares? 40,000 shares multiplied by. On 1st May 2028, each share worth 6 pounds. Okay. Into 6 pounds. So 40,000 shares into 6. So that gives us 240,000. That remains the same in both of them. Base cost of 40,000 shares. Now, how will I get the base cost of 40,000 shares? See, if incorporation relief is claimed, base cost is 53,465 pounds for 200,000 shares. And if incorporation relief is disapplied, it's 900,000 pounds. Okay, so let's look at it. 53,465 pounds is a base cost for 200,000 shares multiplied by 40,000 shares. 53,465 divided by 200,000 shares multiplied by 40,000 shares. So here the base cost is 10693. And here what will be the base cost? 900,000 pounds was the cost of 200,000 shares. Okay. 900,000 pounds was the cost of 200,000 shares multiplied by 40,000 shares. Because in one situation you claimed incorporation relief, so the base cost was reduced, and in other one the base cost was not reduced. So 180,000 pounds. Now this will be your chargeable gain. So 240,000 minus 10693, it's 229,307, and here it's 60,000 pounds. Annual exemption is already used as per the question. Already used. Okay, the question says so. This gives us the taxable gain 229,307, and here it is 60,000. So what will be the capital gain tax? See, on these 40,000 shares, business asset disposal relief will not be available. Why it will not be available? The reason is that our shareholding is only 3.1%. which is less than 5%. And due to same reason, gift relief is also not available because our shareholding is less than 5%. Company is a quoted company, it's a listed company. So 229,307. And if you remember the scenario, it was written that both of them are wealthy people and they are additional rate taxpayers. Okay. They pay income tax at additional rate. So this means that basic rate band is already used. So now the CGT will be at 24% rate. Sir, will you repeat the things again? Yes, I will repeat. But your patience while I'm teaching is very important. 55,033 and here 60,000 pounds into 24%, 14,400. We will add a note here, note 4. Business asset disposal relief will not be available on gift of Glow PLC shares as Camilla's shareholding is less than 5% in Glow PLC. Additionally, gift holdover relief was also not available as Glow PLC is a listed company and Camilla's shareholding was less than 5%. So gift relief was also not available and business asset disposal relief was also not available. Okay, here you go. So these are your capital gain tax on the gift of shares. So if you look at it, what we started our working with was that we, first of all, we did the sale of the business of AK Partnership to Glow PLC. The question was that if incorporation relief is applied or if it is disclaimed. We commented that what chargeable gain will include. We did the incorporation relief, we did chargeable now, we did capital gain tax. Then the base cost of the shares and then gift of shares. Now what will be the tax payment date? Now this is happening in May 28. So this is tax year of 28-29. Okay. Capital gain tax on gift of shares on 1st May 2028 will be payable on 31st of January 2030. Why? Because May 28 is tax year of 28-29. The tax will be payable on 31st of January 2030. 31st January after the end of the tax year. Okay. Now see what he's asking. Let's come back. The review should encompass the sale of AK Partnership business, the gift of shares to Camilla's son, and the effect of the incorporation relief on the base cost of the remaining shares owned by Camilla. Last thing, base cost of remaining shares owned by Camilla. Okay, remaining shares are, you got 200,000 shares. Out of that, you gifted 40,000 shares gifted. So balance shares will be 160,000 shares. So what is the base cost of these shares? The base cost of 200,000 shares. What was the base cost of 200,000 shares? In case of incorporation relief, it was 53,465. And in case of incorporation relief disclaimed, it was 900,000 pounds. Okay. Cost allocated to 40,000 shares gifted. You did it yourself. 10693. 10693. And here it was 180,000 pounds. So base cost of remaining 160,000 shares held by Camilla. 53,465 minus 1,069. So that gives us 42,700 772 pounds. And here it's 900,000 minus 180. So it's 720,000. So this is the base cost of remaining 160,000 shares held by Camilla. Now let's go and read further. As she intends to sell all of her shares in Glow PLC in the next few years. So this first paragraph is done. See, let me repeat it again. I know that you guys must be confused by this point of time. See, it's a 14 marks requirement, so you have to go in a structured manner. If you will rush, you will get in problem. You have to go step by step. Impact of incorporation relief. So in order to calculate the impact, there is only one way. If it is applied and if it is disclaimed. What is the chargeable gain on sale of business? On sale of business, three assets were transferred: goodwill, inventory and receivable, and equipment. Goodwill is chargeable, inventory receivable exempt, equipment was also exempt because it was sold at less than cost. Then comes incorporation relief on share consideration portion. Okay, so we did incorporation relief. Okay, 950,000 pounds was the gain, multiplied by share consideration 900,000 divided by total consideration 1,010,000. Chargeable now, annual exemption was already used. Business asset disposal relief was available. Why business asset disposal relief was available? Because it was sale of ongoing business. Okay, and the business was done for more than 2 years. So it was a gain of goodwill, but restriction did not apply. The reason was that it was not a goodwill sale to a closed company. If we would be selling it to a closed company, it would be a problem. It was not a problem here. The reason was that Glow PLC was not a closed company, so normal badder will be available. See, I am doing two workings in parallel, if IR is applied and if IR is disclaimed. Then we did base cost of shares. We hit IR, we got base cost. Then we did gift of 40,000 shares. Obviously, you allocated base cost on 40,000 shares. This was the base cost of 200,000 shares. You allocated it on 40,000 shares. You got chargeable now. Annual exemption was already used. It was stated in the question. This time, business asset disposal relief was not available because in Glow PLC, our shareholding was not at least 5%. And then you got the base cost of remaining shares. Okay. Now let's see what further he is asking. Okay. Let's see. You should include a summary of your calculation. Okay. A summary of your calculation and a statement of the key issues for me to discuss with Camilla. So only this is remaining. You should also include brief explanation of the amount of incorporation relief available. Done. Availability of any additional or alternative reliefs. Done. Business asset disposal relief, gift relief explained. The dates on which CGT will be payable, that is also done. So now only thing which I have to make is summary of the calculation. Summary of the calculation and a key statement which Camilla has to know. Okay, fair enough. Okay, what is the summary of the calculation? If incorporation relief is claimed and if or is applied, and if incorporation relief is disclaimed. Okay, summary of calculation and the key issue for me to discuss with Camilla. Summary of the calculation and key issue to discuss. Now, obviously, the question is almost towards the end. So what is the summary of the calculation? Capital gain tax payable on sale of ACCA partnership business to Glow PLC. What was the capital gain tax payable? Sale of ACCA partnership business, if incorporation relief is applied, it was 14485. 14485. And if incorporation relief is disclaimed, it was 133,000 pounds. Okay. 133,000 pounds. Capital gain tax payable on gift of 40,000 shares to nephew. So what was the capital gain tax on gift of 40,000 shares? 55,033 here. And in this case, it was 14,400. So total capital gain tax payable 14,485 plus 55,033. Let me reconfirm the values also. Sorry. It was 14,485 and here it's 55,033. Yes. So this is 69,518 pounds. And here it's 14,400 and above it was 133. 133,000 and 14,400. So this is 147,400. See, I'm making a summary of my calculation. I'm making a summary of my calculation as he asked. So I'm making a summary that what is my total tax payable in both of the situations. Okay. Additionally, base cost of remaining 160,000 shares held by Camilla. So what is the base cost of remaining 160,000 shares? 42,772 pounds. 42,772 pounds. And here the base cost is 720,000 pounds. See, I want you all to listen to me very carefully. Okay, let me remove this column. No. So this is my total capital gain tax and this is the base cost of remaining shares. Okay, this is the summary of the calculation. Capital gain tax payable on sale of ACCA partnership business. Okay, this was the capital gain tax in both of the situation and capital gain tax on gift of remaining shares. Now I have the key issue to discuss. If incorporation relief is claimed, then total CGT of Camilla on both of the transactions currently planned will reduce by how much? See, if we are claiming, or if I would say if incorporation relief is applied, then total CGT will reduce by how much? If it is disclaimed, my total CGT is 147,400. But if incorporation relief is applied, my total CGT is 69518. So it will reduce by how much? 147,400 minus 69,518 pounds. So it will reduce by how much? It will reduce by 77,882 pounds. That's logical. I'm summarizing and I'm writing the key issues which I have to discuss. If incorporation relief is applied, then total CGT of Camilla on both of the transactions currently planned will reduce by how much? 147,400 minus 69,518. However, it is to note that if incorporation relief is applied, base cost of remaining 160,000 shares is lesser by how much amount? See, now use your mind. When my base cost is lower, listen to my words carefully. If my base cost is lower, my future CGT will be higher. Why? Because when I will sell these remaining 160,000 shares, disposal proceed of 160,000 shares less the base cost. In situation of incorporation relief is applied, the base cost will be 42,772. Whereas in case of disclaimed, it will be 720,000. So if the base cost will be higher, your gain will be lower. Okay. However, it is to note that if incorporation relief is applied, base cost of remaining 160,000 shares is lesser by how much? 720,000 pounds minus 42,772 pounds. 720,000 pounds minus 42, 772. So this gives us a difference of 677 to 28 pounds. This lower base cost will increase future CGT when these 160,000 shares will be sold. Potential CGT impact will be how much? 677 to 28 into 24%. Why? Why it will be 24%? Because on Globe PLC shares we are not getting better. Into 24%. So that will be 162,535. This means that on overall impact, which includes consideration of future sale of remaining 160,000 shares, CGT of Camilla will increase if incorporation relief is claimed by how much? 162,535 minus 77,882 pounds. Now I know that by now you guys must be thinking that sir, the things are going out of our control. Don't worry. I will repeat each and everything again. So your potential CGT will increase by 84,653 pounds. This is the key issue which Camilla has to understand. This is the key issue which Camilla has to understand, that in future the capital gain tax may increase, and when in future your capital gain tax will increase, it will impact a greater liability. It's a 14 marks requirement. Believe me, before explaining it in detail, this entire question involved a very basic relief of incorporation relief. Incorporation relief is one of the basic concepts in advanced taxation. But just look at the examiner. He made that small concept so much difficult. He has this ability. So you have to give importance to each and every topic in your preparation. Okay, let me repeat it again. Sale of business to Globe PLC. If incorporation relief is applied and if it is disclaimed, because the question was its impact. Chargeable gain was only on goodwill because other two assets were exempt. Incorporation relief on share consideration portion, you got chargeable now. Annual exemption was already used. You applied CGT, business asset disposal relief was available because it was sale of ongoing business. Goodwill restriction was not applied because it was not a closed company. Then the base cost of the shares. Market value, less incorporation relief, you got the base cost for 200,000 shares which you received. Then gift of further shares. 40,000 shares were gifted to nephew. Okay. Were gifted to Camilla's son or Camilla's nephew. To son. Were gifted to Camilla's son. So on that, market value, less the cost. Here, 53,465 was divided if incorporation relief is applied, and in other part, if incorporation relief is disclaimed, that base cost was used. Chargeable gain, annual exemption, taxable gain. CGT, 24% because badder was not available. Because this time in Globe PLC, our shareholding was not 5%. Okay, and gift holdover relief was also not available. And then we calculated the base cost of remaining 160,000 shares. For 200,000 shares, this was the base cost you yourself calculated. From this much cost has already been assessed on 40,000 shares which we gifted. So this was the base cost. Now the summary. All the CGTs which are payable, you talked on that, and the base cost. Currently, if incorporation relief is claimed, if incorporation relief is applied, your CGT is lesser. You are paying CGT lesser by 77,882 pounds. But if you are applying incorporation relief, then your base cost of remaining shares gets low because incorporation relief reduces the base cost. Lower base cost will increase future CGT. Okay, so your future CGT may increase by 162,535 pounds. So the overall impact which includes consideration of future sale of remaining shares, CGT of Camela will increase if incorporation relief is applied. Your CGT will increase by how much? It will increase by 84,653 because currently it's lower by 77, but in future it will increase by 162. So the net impact which you will have to face is 84,653. I hope that you have understood this requirement. I know that this was a difficult one. Not difficult by concept, difficult by the workings because there were lengthy workings involved. Now comes the last part, which is part C, Nova Limited Review of Corporation Tax Computation. Please review the computation and related notes in order to identify any errors and prepare a revised schedule showing calculation of the correct tax table and the corporation tax liability. You should include notes explaining the errors you have identified and the changes you have made. 11 marks requirement. Nova Limited, which we haven't read it, we have to read this part. Okay, because we only read exhibit number 1, which was ACCA partnership. So let's move forward. I know that part B was a good one. Part C is also interesting, by the way. Okay, so now let's look at part C. If you get tired, you can pause the recording for time being. You can go and get yourself refreshed and you can come back also. Because I know long classes are a bit burdened, so don't worry. At any time it's recorded session, you can pause and get yourself refreshed. So now let's look at part C. Okay, so now let's read this exhibit number 2, which is Nova Limited, from which the examiner has asked this requirement, part C. Let's read it. Information provided by your manager and computation prepared by tax assistant. Background, the Orbit Limited Group. Now, Orbit Limited owns 100% shares in Nova Limited. And Nova Limited owns 100% shares in Luna Limited. Then Nova Limited owns 25% shares in Solar Limited, but 75% shares of Solar Limited are owned by Astral Limited. Now here, if you analyze it carefully, Orbit, Nova and Luna, they can form their groups. They can form their 75% group and they can form their capital gains group. Orbit, Nova and Luna. Whereas Astral and Solar Limited will form their own group because Astral Limited owns 75% shares in Solar Limited. So there are two groups in this question. One is Orbit, Nova and Luna. That's a separate group. And then there is one separate group between Astral and Solar Limited. Okay. Let's read further what the question is saying. All 5 companies are UK resident trading company. The only changes to the group structure in recent years relate to the purchase and subsequent sale of Luna Limited by Nova Limited as set out in Note 3 of the Corporation Tax Computation Bill. Astral Limited has no links to the Orbit Limited Group other than its shareholding in Solar Limited. Nova Limited's corporate tax computation for the year ended 30th June 2026. So we are provided with some draft computations. We have to identify mistakes from it and we have to discuss. Now tax adjusted trading income £190,000. Note 1 and Note 2 need to be read. Then sale of Luna Limited for 517,000, less cost 410,000. Then annual exemption is recorded of 3,000. That's wrong. There is no annual exemption in corporate taxes. Annual exemption is the concept of individuals. 104,000 to 94,000 is shown as the profit. Then some loss reliefs are claimed from Luna Limited and Solar Limited. See, this computation is of Nova Limited. Nova Limited claiming loss relief of Luna Limited and it is also claiming loss relief of Solar Limited. Okay, Luna Limited is its 100% subsidiary. But in Solar Limited, it has only 25% holding. So, sir, can we form consortium? The answer is no. Because Solar Limited will form its own group with Astral Limited. For consortium, it is necessary that collective shareholding becomes 75%. If one particular company will own 75%, that will form its own group. Then there won't be any consortium. For consortium, collective ownership should be 75%. such that none of the party itself owns 75. Like here, if Astral Limited itself owns 75%, it will form a 75% group with Solar Limited. It will not go for consortium. So now Nova Limited cannot access Solar Limited losses because Solar Limited is in 75% group of Astral Limited. So this loss relief of Solar Limited is also wrong. Then taxable total profits are shown and corporate tax is recorded. Let's read the notes. The treatment of the following items of expenditures need to be checked. The cost of establishing a non-tax advantaged share option scheme. So he has recorded it as an allowed expense. See, here you need to understand that if it is a non-advantageous scheme, which means it is an unapproved share plan. If it is an unapproved share plan, then in that case, it's not an allowed expense. If it is an unapproved share plan, then in that case, it's not an allowed expense. This 7,000 which he has recorded is wrong. Then comes the cost of entertaining staff. Okay, fair enough. That is allowed expense because they are entertaining the staff. Staff entertainment is allowed. Accrued management bonuses to be paid on 1st May 2027. What is the year end? Year end is 30th June 2026. See, management bonuses are allowed expenses if they are paid within 9 months of the year end. So if you count 9 months, July, August, September, October, November, December, January, February and March. It is getting paid 9 months after the year end. It is getting paid in May 27. So it won't be deductible in the current year. It will be deducted in the next year. If you pay it 9 months within the year end, then its accrual expenses allowed expense. These are small adjustments. We will look at them in detail when we will be solving it. The tax adjusted trading income is after deducting a total of £45,000 in respect of research and development expenditure. The expenditure consisted of salaries paid to Nova Limited staff of £19,000 and payments for subcontracted labor of £26,000. So they have already claimed an allowed expense of £45,000. But this includes salaries to the staff and subcontract staff salary. So there is a concept of research and development expenditure credit. So they have claimed an allowed expense, but they have not claimed the tax credit. If you remember research and development topic, on the qualifying expenses, you get a tax credit. Okay, if you don't remember the rules, just go in the summary notes, write research and development. On the qualifying expenses, you get a tax credit. Okay, you get an additional relief. Okay, additional relief is available. It's on staff salaries, subcontractor staff cost qualifies on 65% of the portion. The tax credit is 20%. That tax credit is deductible from your tax liability, but at the same time, it becomes your income also. Okay, so that concept also we'll look at it when we'll be solving. Then Luna Limited was purchased on 1st November 2025. On 1st February 26, Nova Limited signed a contract to sell Luna Limited. So it remained in our group for how many months? November, December and January. Because on 1st February, we signed the sale contract. The sale actually took place on 31st March. See, the loss relief stops. Listen to my words. The loss relief stops on the date. The loss relief stops on the date we sign the contract to sale. So loss relief, which they have claimed for how many months? 5 months. This is also wrong. The loss relief has to be for 3 months only. Okay. Accordingly, the substantial shareholding exemption was not available. The sale of Luna Limited resulted in degrouping charge of 33,500. This has been included as a chargeable gain in corporate tax computation of Luna Limited. See, this is also wrong. Degrouping charge is not charged on that company. Rather, degrouping charge is charged on the parent company. If you remember, degrouping charge is added in the gain on disposal of shares. So basically, this 33,500 should be taxed here. This 33,500 should be taxed along with the sale proceed on sale of Luna Limited. It won't be taxed on Luna Limited. It will be taxed on Nova Limited, which is the parent company. Luna Limited made a tax-adjusted trading loss of £72,000 in the year ended 30th June 2026. Solar Limited made a tax-adjusted trading loss of 38,500 in the year ended 30th June 2026 and did not pay a dividend. Additional information provided by your manager. The corporate tax computation for Nova Limited for the year ending 30th June has been prepared by an inexperienced tax assistant and may contain errors. Yes, there are a lot of errors. We have identified it. I have established that the expenditure incurred by Nova Limited on research and development is a qualifying expenditure for the purpose of R&D relief. The payments for subcontracted labor were made to an unconnected external subcontractor. So for research and development tax credit, it's a qualifying expenditure. We will claim the tax credit. I can confirm that substantial shareholding exemption is not available in respect of disposal of Luna Limited, and that the figures given for the cost of Luna Limited in the schedule, degrouping charge in Note 3, and tax-adjusted trading losses in Note 4 and Note 5 all have been calculated correctly. So this means that this degrouping charge is calculated correctly, but the classification may be wrong. He has taxed it on Luna Limited, whereas degrouping charge is taxed on the parent, not on that particular company like Luna Limited. So what we have to do is we have to calculate the revised computation. Please review the computation and the related notes in Exhibit 2 in order to identify any errors and prepare a revised schedule showing calculation of the correct taxable total profits and corporate tax liability. You should include notes explaining the errors you have identified and the changes you have made. So we have to do the revised calculation of the Nova Limited profits, and we have to explain the corrections which we are making. Okay, we have to explain the corrections which we are making in the profits of the Luna Limited. Okay, so let's look at it. Let's see that what adjustments we have to do. Okay, I want you all to listen to me carefully. Okay, so let's look at it. Let's start making the revised corporate tax computation, and along with this, we'll also be making the commentary. Okay, so now if you look at the question, tax adjusted trading income, which is given in the scenario of Nova Limited is 190,000, and then we'll start making the adjustments. Tax adjusted trading income of Nova Limited as per original schedule. How much is the tax adjusted trading income which he has shown? He has shown it as 190,000 pounds. Okay, fair enough. 190,000 pounds. Now, in this trading income, we need to refer Note 1 and Note 2. So let's go and refer it. The treatment of the following items of expenditure need to be checked. The cost of establishing a non-tax advantageous share option scheme, 7,000, he has considered it as an allowed expense. Okay. So cost of establishing non-tax advantageous share option scheme. So we will add it back 7,000 pounds. Okay. We will add this back. Note 1. Cost of establishing non-tax advantageous share option scheme is not an allowed expense from trading P&L. Okay. So in draft schedule, it was considered as an allowed expense. Therefore, its relief will be reversed. So he has considered it as an allowed expense. We are reversing it. We are adding it back. We are adding it back. Okay. Then the cost of entertaining staff, that's a normal allowed expense. There is no issue in it. So just ignore it. Accrued management bonuses. Accrued management bonuses paid on 1st May 2027. So this is also not an allowed expense, 11,000. He has considered it as an allowed expense. We will add it back. Okay. So we are basically doing the corrections. Okay. Accrued management bonus will not be an allowed expense as it is paid more than 9 months late after the year end of 30th June 2026. Its amount will also be added back to reverse allowed expense claimed. Okay, so what we are doing, we started with the profits which he has given and we are making the adjustments in it. So in this 190,000 pounds, he has claimed allowed expenses for these things. He has taken the allowed expense for non-tax advantageous scheme, which is unapproved plan. So we added it back. Cost of entertaining staff is a normal allowed expense. So we remained silent. Accrued management bonuses were paid 9 months later than year end. So they are also not an allowed expense. So we reversed it. Then the tax adjusted trading income is after deducting a total of 45,000 pounds in respect of research and development expenditure. Fair enough. He has claimed the allowed expense, that's allowed. The expenditure consisted of salaries paid to Nova Limited staff of 19,000 pounds and payment for subcontracted labor of 26,000 pounds. So we will get a research and development expenditure credit. See, this credit is deductible from your final tax liability. Okay, but at the same time, it is also considered as your income. So when it is considered as your income, for example, if your corporate tax rate is 25%. So for example, if you are getting a tax credit of 1,000 pounds, it will get taxed at 25%. So you'll have to pay a tax of 250 pounds on this tax credit. But entire 1,000 will be deducted from your liability. Research and development expenditure credit. It becomes your income. Research and development expenditure credit. So this research and development expenditure credit will be considered as your income. Okay. Note 3. Research and development expenditure credit will be taxed as an income for Nova Limited. However, it will also be deductible from tax liability. Now here some students get confused. They say that, sir, first you are adding it and then you are deducting, so the net effect becomes zero. No. The net effect don't become zero. When you add it in your income, only its 25% portion will be taxed. For example, corporate tax rate is 25%. Okay. But when you deduct from your liability, you deduct the entire 100% amount. Okay. So RDEC will be on how much amount? Will be on staff salary amount of 19,000 and 65% of subcontracted labor cost. Research and development expenditure credit will be 100% on Nova Limited's staff salary involved in research and development, and it will be on 65% portion of subcontract staff cost. Okay. So RDEC will be 19,000 pounds is its own salary and 26,000 is the subcontract staff salary. 19,000 pounds plus 26,000 pounds into 65%. Okay. So the total will be plus 19,000. So that brings to 35,900 into 20% is the credit rate. 7180 pound. So this 7180 pound will first become your income and then it will be deductible from your final tax liability also. Okay. See, you need to understand these concepts. We have already studied them during our class discussions also. Okay. Then if you move forward, there is this capital gain, sale of Luna Limited. Proceeds 517,000, less cost 410,000. He has recorded an annual exemption which is wrong. Okay. Sale of Luna Limited shares. Note 4. Okay. In calculation of sale of Luna Limited shares, annual exemption of £3,000 is considered. It is wrong, as annual exemption is not available to companies. Okay. Additionally, degrouping charge of how much? Degrouping charge of 33,500. Additionally, degrouping charge of 33,500 pounds will be added in sale proceed of Luna Limited shares, and it will be included in corporate tax computation of Nova Limited, which was the parent company. Okay. In draft schedule, it is included in corporate tax computation of Luna Limited, which is wrong. See, I will repeat it again. See, when you sold the shares of Luna Limited, he included annual exemption. That is wrong, first of all. Then secondly, degrouping charge of 33,500 will be taxed on the parent. Degrouping charge is taxed on the parent. Additionally, degrouping charge of 33,500 will be added in sale proceed of Luna Limited shares, and it will be included in corporate tax computation of Nova Limited, which was the parent company. In draft schedule, it is included in corporate tax computation of Luna Limited, which is wrong. He said that he has included it in computations of Luna Limited. That's a wrong working. Okay. So if you look at it, 517,000 was the sale proceed. Okay. 517,000 was the sale proceed, plus 33,500 will be the degrouping charge element, less the cost. The cost is 410,000. Less the cost, which is 410,000. So 517 plus 33,500 minus 410,000. So 140,500 will be the amount which will be taxed on sale of Luna Limited shares. Okay. Is it clear? Now, so you are done with note number 3, which was on the sale. Now comes the loss thing. So revised total income of Nova Limited. Now what is the revised total income? 190,000, 7,000, 11,000. Okay. Then 7180 and 140,500. So that brings the total to 355,680 pounds. Okay. That brings the total to 355,680 pounds. Now you will claim loss relief of Luna Limited's trading loss. So let's look at it. Note 5. Okay. Loss relief in relation to Luna Limited's trading loss can only be claimed for 3 months, as Luna Limited was acquired on what date? Luna Limited was acquired on 1st November 25, and on 1st February 26 contract to sale was done. Okay. Was acquired on 1st November 2025, and contract to sell it was done on 1st February 2026. Okay. In draft computation, loss relief is wrongly taken for 5 months. Okay. He has wrongly taken the loss relief for 5 months. Now the Luna Limited's loss is 72,000 pounds. Luna Limited's loss is 72,000 pounds, which he has relieved for 5 months, whereas we need to relieve it for 3 months only. Okay. So 72,000 pounds loss relief will be 72,000 pounds divided by 12 months into 3 months. Now here some students ask a very, I would say, a stupid query. They say, sir, why are you dividing it by 12 when we acquired it in the month of November? No, we acquired it in November, we sold it in February. Our loss relief is of 3 months, but Luna Limited has made its accounts for the entire year. Luna Limited has made its account for the entire year. So the division will be by 12 months only. Okay. So 72,000 divided by 12 into 3. So the loss relief will be of 18,000 pounds. Here we go. And then loss relief in relation to Solar Limited loss claimed in draft computation is wrong. Okay. Solar Limited is in 75% group with what's the name of company? Solar Limited. He has claimed loss relief on Solar Limited also. That's wrong. Is in 75% group with Astral Limited. Is in 75% group with Astral Limited. Therefore, consortium relief will not be available to Nova Limited despite of its 25% shareholding, because it will form its own 75% group with them. So now revised taxable income, because there is no qualifying donation or thing like that. So this will be 337,680 pounds. Okay, it will be 337,680 pounds, which will be assessed. Now on this we will charge corporate tax, corporation tax, 337,680 pounds into 25%. So this will give us 84,420 pounds. Research and development expenditure credit. See, this is important thing. When you added the credit here, it was only taxed at 25% because this credit is part of this income. It was taxed at 25%. So 25% portion of this is included in liability. But when I'm claiming the credit, I'm deducting the entire 100% amount. So this reduces my corporate tax liability. My corporate tax liability will be how much? My revised corporate tax liability is 77,240 pounds. Sir, will you repeat the question again? Yes, I will repeat the question again. But your patience and concentration is most important. Okay. Now, let's look at it again. Let's look at this requirement again. It's done. Okay. It was how many marks requirement? It was an 11 marks requirement. We have explained the errors and the changes we have done. We have explained them. Now let's review this requirement again. Let me explain you the points again so that if there is any query, it gets cleared. So if we take a quick review, so we started with the trading income of Nova Limited as per the original schedule. Original schedule means the working which was done by the tax inexperienced tax junior, which he referred here. Okay. By an inexperienced tax assistant, we started with the trading profit. Then there were some adjustments. So unapproved share plan allowed expense shouldn't have been done. He has taken allowed expense, so we reversed it. Accrued management bonus expense, that was also reversed because it was not paid within 9 months of the year end. Staff entertainment cost was simply ignored because he took it as an allowed expense and that was acceptable. Research and development expenditure credit will be considered as an income. It will be subject to corporate tax and then it will be treated as a tax credit. Okay, we have discussed its logic. Then sale of Luna Limited shares, he included annual exemption. That was wrong. Then he missed out the degrouping charge thing, so we included that. He taxed degrouping charge on Luna Limited, which was wrong. It should be taxed on the parent company, which was Nova Limited, for which we are doing working. We got revised total income. We took loss relief of Luna Limited's trading loss. We got revised taxable income, and we did the corporate tax. So with this question number 1 is done. So if I look at this complete question, I wouldn't say that it was very easy. Okay, like it had some difficult requirements. Like part A was very easy. It was relating to ethics, a very routine requirement. Then requirement in relation to capital allowance was also a very straightforward one. Then this requirement of inheritance tax was also very easy. But then this impact of incorporation relief, this was an interesting requirement where you have to make a comparison if incorporation relief is applied and if it is disclaimed. That was a detailed working and obviously 14 marks requirement. And then this corporate tax working, I would say that even though a student would miss out some things and won't be able to secure complete 11 marks, but still a normal student can go for around 7 to 8 marks easily because some adjustments are very easy, like research and development, degrouping charge and things like that. So with this question number 1 is done. So now we have done this question number 1 of our official mock exam of June 26 attempt. In next class, we'll look at question 2 and 3, same detailed approach, detailed analysis, and so on. So in this series, we are looking at 7 complete attempt exam papers. Okay, and then you have to do 3 mock exams on your own and send me for checking and feedback. Believe me, this strategy of mine has been very successful in my 15 years teaching experience. These past paper revision sessions, these ethics handouts, these summary notes, these all are life-saving documents. If you need any support, you can always contact me directly on my WhatsApp number. Okay, so hope to see you all in the next class when we'll move forward towards question number 2 and question number 3 of this exam. Thank you, everyone.